Okay, hi everyone. This is going to be the problems for Chapter 8. So we have a variety of them here. It looks like there are a lot. Some of these are like one shot, like pretty quick, so don't be too overwhelmed here. Beginning here, right at exercise 8.1, it says Silver Company makes a product that is very popular as a Mother's Day gift. Thus, peak sales occur in May of each year, as shown in the company's sales budget for the second quarter below. Okay, so they give us a sales budget for April, May, June. Looks like we're peaking there in May because of Mother's Day. It says, from past experience, the company has learned that 20% of a month's sales are collected in the month of the sale. Another 70% are collected in the month following the sale, and the remaining 10% are collected in the second month following the sale. Bad debts are negligible and can be ignored. February sales total $230,000, and March sales total $260,000. So they say, using Schedule 1 as your guide, prepare a schedule of expected cash collections from sales by month and in total for the second quarter. And then they want to know what is accounts receivable on June 30th. Right, so if we were just looking at this, right, if we sell something in month 1, right, it looks like per these facts we collect 20% of it then, right, if we sell on account then. In month 2, we're going to collect 70% of that month 1 sale. And then in month 3, right, we collect the remaining 10%. So what we're going to do here, right, we have to do it per month and for total. So let's create a little chart here, right? So we can have April, May, June, and then total. So for February sales, right here, it looks like in February, we can make this blue. Let's see here, they're saying February sales total $230,000. Right, so that means in this case, right, if we were filling this out, that in February, that was month 1, month 2 is March, so April is month 3, right? So 10%, $230,000 times 10%, we would collect then, right? And we could just make this guy a little formula right here, and we'll drag that down at the very end. Okay, March sales, if we look at it, so maybe we'll make that yellow. They're telling us March sales total $260,000, right? So we have March, April, we must get 70% of that. May, we must get 10% of that, right? So we would take the March sales of $260,000 times, let's see here, 70% in month 2, 182, and then we would take the 260,000 times 10% there for May. Right, all you need to do is just graph it on here. Month 1, carry it over, carry it over. All right, then looking at it in this case, right, then we're going to have April, May, and June, right? And they're giving us some budgeted sales over here, right? So we're going to do for April, in the month of sale, right, it's 20%. In the second month, right, that 300,000, it's going to be 70%, right? And in the third month, it's going to be that 300,000 times 10%. Okay. Then for May, right, they're saying 500,000. So in the month of times 20% in month one. This one's going to be 500,000 times 70% in month two, right? We're not worrying about after that because, again, they're just asking us to do the schedule for the quarter there, right, for those 3 months, cash collections. June here, right, the only thing we'll have is June. So it looks like we did 200,000 in June. In the month of, right, we collect 20%. So we're looking at 40,000. So here we'll just drag the formula down, right? All it is doing is adding across there. So we're looking at 23, 208, 300, 450, 440, right? And this is going to be total cash collections. Top border, and we can just do a formula here. We'll sum all of those guys, right? Just adding them up, not a big deal there. So one of the things it says here, right, that you should be aware of is notice that even though the sales peak in May, cash collections peak in June, right? There's a little bit of a disparity there. And the reason for that, why this occurs, is because the bulk of the company's customers pay in the month following the sale. There's a lag, right? The lag in connections, this is going to create a delay there for when they collect the cash. So again, if you were budgeting, why would you care about this? Well, it's great we have the sales in 1 month, but we only really collect it in another month. All right, so then they want accounts receivable at June 30th. Right, so what we really would have to then look at here is we have a little bit of May, right? So we collected some then, some then. So we have our May sales that we have, right? So we had May, we collected that, cash, collected that. So we have outstanding 10% left in May, right? So the 500,000, they're going to pay us next month, not in this quarter. And then in June, right, the sales from that, we're going to have, let's see here, 200,000 of the sales times 0.70% plus 0.10%, right? That month two collection in cash, month three. We haven't collected it yet, right? We're looking at $1.60 there. We add those two together, right, 210. That's going to give us our accounts receivable at June 30th. In other words, it's a sale that we made that we haven't collected the cash for. Okay, so let's move on to a 2 here, see what they're asking for in this case. All right, they're telling us down under products of Australia. Okay, I guess it's like a pun, right? Down under Australia. They have budgeted sales of its popular boomerang for the next 4 months as follows, right? So they're giving us 4 months of budgeted sales. The company's now in the process of preparing a production budget for the second quarter. Past experience has shown that the end of month inventory levels must equal 10% of the following month's unit sales. The inventory at the end of March was 5,000 units. So what they want us to do here is prepare a production budget. Okay? And again, what we can do here is we can have April, May, June, and then for the quarter in total. First thing we'll have in this case are our budgeted sales. Right, we can snag that information right from over there, that chart. Right, 50,000, 75,000, 90,000, and then we'll just add them up. For the quarter, right, 215. The next thing, right, we're going to have in our production budget is we need to add our desired finished goods inventory in units. Right, so let me build this out a little bit. Now this one's a little bit tricky because we got to think about this. Right, they're saying here that end of month inventory levels must equal 10% of the following month's unit sales. Right, so in this case, our ending inventory at the end of April has to equal 10% of what our May sales are going to be. Right, so we would do this 75 our next month times 10%. Same logic for this guy, right? 90,000 times 10%. And this one in June, right, it would be the 80,000 from July times 10%. Carry that down. And in this way, right, at the end of the quarter, we're going to want it to be 8,000, right? So that will give us our total needs. Right, we'll just add these together here, right? 57. Right, so in total for the month, we'll have, what we sold plus what we need to have on, in our ending inventory. That's our total, okay? We'll back out from that our beginning finished goods, right? So less back out our beginning finished goods inventory. Again, that's in units. Now, when we look at this, right, they're saying the ending inventory at the end of March was 5,000 units, okay? So if at the end of March, right, last period's ending is this year, this month's beginning. If we had 5,000 at the end of the March, we must have had 5,000 at the beginning of April, right? So that means what we can do here, let me build this out, right? This is going to show our required production in units. Right, that guy minus that guy. Likewise, we can kind of see here, right, that it's going to be a function of 10% of the budgeted sales, right? So for the 75,000, it's going to be the 75,000 times 10%. For that one, it's going to be 9,000. In this one here, right, this is at the beginning of the quarter, right? So the quarter, our beginning inventory at the corner was 5,000, so that makes sense over there. And we can just, carry down the math on it. 76,500, 89,000, and 218. Right, so not that difficult there. You kind of have to think about it a little bit based off the facts. This is just really meant to show you a production budget, right? We're looking at our sales. We would start with something like that. And you would compare that with what you need in your ending finished goods inventory versus what your beginning finished goods inventory. And that would say, well, you have to produce this amount, right? This is how much we have to produce to satisfy all of these other needs. All right, let's look here at exercise 8.3. It says 3 grams of musk oil are required for each bottle of mink Karis, a very popular perfume made by a small company in western Siberia. It says the cost of musk oil is $1.50 per gram. Budgeted production of mink cases is below for the quarters for year 2 and for the first quarter of year 3. Okay, so they're basically saying, here's some facts about a product we make. Here's some budgeted production, what we're going to have to produce, what we expect. Then it says the inventory of musk oil at the end of a quarter must be equal to 20% of the following quarter's production needs. Some 36,000 grams of musk oil will be on hand to start the first quarter of year 2. Okay, so what they want us to do here is using Schedule 3, please prepare a direct materials budget for musk oil by quarter and in total for year 2. Okay, so for this, right, we're going to do it by quarter first, right? So we'll have quarter 1, quarter 2, quarter 3, quarter 4, and then we'll have for the year in total. First thing we're going to have over here, right, is going to be our required production in units of finished goods. Okay, so basically this is our required production. We can snag this right from over here, right? 60,000, 90,000, 150,000, 100,000. Add all of these together for the year, right? You're looking at 400. And then what we have to do is multiply that times the units of raw materials needed per unit. Right, so over here they're telling us that, let's look in the facts here. 3 grams of musk oil are required for each bottle. Right, so we're doing this many bottles to produce. We're going to need 3 grams of it for each. Right, so that will give us our units of raw material to meet production. In other words, if you want to produce this many and there's 3 in each, we're going to have to take 3. We can carry that across. Right, just multiply it down. All right, the next thing, right, when we're doing this, we're going to add to this our desired ending raw materials inventory. Okay? Okay, so for this, we kind of have to highlight over here. It says the inventory at the end of the quarter must equal 20% of the next quarter's. Hold on 1 second. Draw. Let me get off that. The following quarter's production needs. Right, so in this case, right, this quarter right here must equal that amount next quarter's production needs times 20%. Same with this guy, right? It must equal next quarter's production needs times 20% equals next quarter's production needs times 20%. Now, the fourth quarter, we have to think about this for a second. Okay, so we don't have it over here, but they do tell us over here what the first quarter of year 3 is going to be. So we can snag it right from there, right? So it's going to be 70,000 times, but again, we have to be careful here, times the 3, right? Because we're trying to find the total amount, times 20, we're looking at 42,000. Okay, and then we can just add those up. Oops, sorry about that. The year ending, right, at the end of the year, it's going to be 42,000. It's where we stand there at the end of the year. So sometimes you add it across. Sometimes they're asking, like, what is your desired at the end of the year? So you kind of have to just read that carefully. All right, that's going to tell us our total units of raw materials needed. All right, so it would be, in this case, the 180 plus the 54. We're looking at 234, 360, 510, 342, 1,242,000. From that, right, we're going to back out our units of beginning raw materials. Okay, so if we look at this, right, they're telling us over here, let's see, some 36,000 grams were on hand to start the quarter. Okay. And then again, if we're looking for our beginning, last month's ending is this month's beginning, right? So last month ending is this month's beginning. Last month's ending is this month's beginning. Last month's ending is this month's beginning. And here, right, because they went for the year, your beginning raw materials, it's 36,000. So you can see this is like a lot of populating numbers. It doesn't really lend itself well to like multiple choice questions in the sense that you can't prepare one of these entire things as a single multiple choice question. So more one-shot type items, a specific area or focus of it. In any event, when we back out those units of beginning raw materials inventory, that's going to give us our units of raw materials that we need to purchase. All right, so if we do the 234 minus the 36, 198, 306, 420, 282, 1206. They're telling us, right, a unit cost, they're saying it's $1.50. So that's going to give us our cost of raw materials. We're looking at 297, 459, 630. 423, 1,809,000. All right, let's move on to exercise 8.4 here. Okay. They're giving us some information. They said the production manager of a corporation has submitted the following quarterly production forecast for the upcoming fiscal year. So units to be produced. Looks like in the first quarter we're planning on producing 8,000. Then 6,500, then 7,000, then 7,500. It says each unit requires 0.35 direct labor hours, and direct laborers are paid $15 an hour. And what they want us to do here, right, they want us to prepare the direct labor budget. Okay, so we have quarter one, quarter two, quarter three, quarter four, and we have for the year. Right, first thing we got to do here is our required production in units. We just snag that right from over there. Right, 8,000, 6,500, 7,000, 7,500. For the year, we add them across. 29,000. Okay, just plugging in information there, nothing too difficult. Now per unit, it says direct labor hour per unit in time, right? It's going to be 0.35 hours. It's across the board. All right, so what we're going to do now is multiply those to figure out our total direct labor hours needed. Again, we can just drag that formula across to get us that amount. So we need this many hours. The cost per direct labor hour, they're telling us, is $15. Okay. Draw that up. Then we can figure out, our total direct labor cost. Just multiply that again. Okay. 42,000, 34,125, 36,750, 39,152. So feel free, right? You can populate that in Excel. Sometimes I move faster than you can handwrite, or you're doing it in the formula. Just pause the video, right? Not a big deal. But that right there is a direct labor budget. All right, so let's move on to 8.5 here. Okay, so they're giving us some information. They're saying the direct labor budget of a corporation for the upcoming fiscal year contains the following details concerning budgeted direct labor hours. Okay. It says the company uses direct labor hours as its overhead allocation base. The variable portion of its predetermined manufacturing overhead rate is $325 per direct labor hour, and its total fixed manufacturing overhead is $48,000 per quarter. The only non-cash item included in fixed manufacturing overhead is depreciation, which is $16 per quarter. Okay, it says using Schedule 5 as your guide. Right, they want us to prepare a manufacturing overhead budget for the upcoming year. And then it says compute the company's predetermined overhead rate for the upcoming fiscal year. Round that off to the nearest whole cent. Okay, so again, we got to do quarter 1, quarter 2, quarter 3, quarter 4, and for the year. Right, so we're dealing with manufacturing overhead here. We know that we're going to look at our predetermined overhead rate, our other items. So we're going to start here with our budgeted direct labor hours. Right, we can just snag this right from over there. 8,000, 8,200, 8,500, 7,800. For the year, we'll add them up. Looking at 32.5. They're saying our variable manufacturing overhead rate in this case, let's see here, it's $325 per direct labor hour. Okay. And let's do the math on that to get our variable manufacturing overhead. Multiply it. It's like 26,000. Carry the formula across there. Then we can back out, in this case, our fixed manufacturing overhead. They tell us over here that that's 48,000 per quarter. Right, so that's fixed. It's the same every quarter at 48,000. Add those two together, right? Add our variable plus our fixed. We're going to have our total manufacturing overhead. 74, just carry that across there. Now, one of the things, and I got to change this right here. Oops, this is going to be the sum of these guys. And let me get rid of that formatting. And put this back up there, that border, okay. All right, we got our total manufacturing overhead here. We got to back out our depreciation. They're saying what that is, 16,000 per quarter. And in total, right, we're looking at, let's just add them up, some 64,000. So we have to back out that non-cash item. And that will get us our cash disbursements for manufacturing overhead. Basically, our cash outlay is what we pay in cash for manufacturing overhead. So 74 minus the 16 is 58. 58,650, 59, 57. Oops. Sorry there, I'm screwing this up today. 233,625. All right, cool, right? That's the manufacturing overhead budget. They then want to know and help us calculate our predetermined overhead rate. All right, so we're going to have our total budgeted manufacturing overhead for the year. Right, in this case, that's going to be our total manufacturing overhead for the year. And then we're going to have our budgeted direct labor hours for the year. Okay, that's going to be 32.5 right from up here. We would calculate our predetermined overhead rate. Right, all we would do here is take the 297 divided by the 32.5. We're looking at, if you round that up there, roughly $9.16 per direct labor hour. Okay? All right, let's move on to exercise 8.6. Right, it looks like we have a company and they have budgeted unit sales for the upcoming year as follows, 4 quarters. It says the company's variable selling and administrative expense per unit is $250. They have fixed selling and administrative expenses that include advertising of $8,000 per quarter, executive salaries of $35,000 per quarter, depreciation of $20,000 per quarter. And it says, in addition, the company will make insurance payments of $5,000 in the first quarter and $5,000 in the third quarter. Finally, property taxes of $8,000 will be paid in the second quarter. And so what is specific information there for what they're paying each quarter? What they want us to do is prepare the selling and administrative budget. Okay, so we will again have, in this case, quarter 1, quarter 2, quarter 3, quarter 4, for the year. All right, first thing we're going to have here is our budgeted unit sales. Right, just like the last time, we usually just plug in the information they gave us. 15,000, 16,000, 14,000, 13,000. If we add those up, we're looking at 58. Right, grab that right from over there. Then what we're going to do is we need to start to figure out our variable selling administrative expense, right? So we have our variable SG&A expense per unit. They're telling us over here it's $250 per unit. Okay, so that will give us our variable SG&A expense, right? We'll just multiply that down. Okay. Next, right, we got to back out our fixed SG&A expenses. And with this, right, we're going to have a few different ones here. We're going to have advertising. We're going to have executive salaries, insurance, property taxes, and depreciation. Okay, it's all the and then we can just have a little total fixed selling general administrative. Okay, so we'll have a little line down here to total it. So advertising, if we go over here, it says, let's see here, it's advertising is $8,000 per quarter. So all quarters are $8,000. Executive salaries, if we go over here, $35 per quarter. Okay. Insurance. Let's see. It says the company will make insurance payment of $5,000 in first quarter and $5,000 in third. Okay, so we'll have $5,000 in the first, $5,000 in the third, and then it says property taxes of $8,000 will be paid in the second quarter. Then it says, let's see here, so the company's $250 fixed, include advertising, executive. Depreciation is $20,000 per quarter. Right, so we can copy that over. Now let's sum these to get the total amount. right, we're looking at 32, 140, 10, 8, and 80. If we add these up here, right, 68,000, we'll just carry this across, right, 71, 68, 63, 62, 70. Then what we can do is we can figure out our total SG&A, right? So what we'll do here is we'll take our variable SG&A plus our fixed SG&A, right? 105. Carry that formula across. And let's put a little formula, a little tab there for that. Okay, then we got to back out our depreciation because that's a non-cash item. And you total that, it's going to be 80,000. That will give you, right, our cash disbursements, our out-of-pocket cash for SG&A. Or in other words, depreciation is a non-cash item. You subtracted it. To reverse that out, you have to, in this amount right here, the 105, it includes the depreciation. We got to back that out, the 20,000 to show us, right? We spent 85, 91, 83, 75, 335. Okay? So again, a lot of line items there. It's just being specific, plugging it in where it goes. Let's look at 8.7 here. Okay, so it says Garden Depot is a retailer that's preparing its budget for the upcoming fiscal year. Management has prepared the following summary of its budgeted cash flows. So we have 4 different quarters there. Basically what we think we're going to collect in cash and what we're going to pay. It says the company's beginning cash balance for the upcoming year is $20,000. It requires a minimum cash balance of $10,000 and may borrow any amount needed from a local bank at a quarterly interest rate of 3%. The company may borrow any amount at the beginning of any quarter and may repay its loans or any part of its loans at the end of any quarter. Interest payments are due on any principal at the time that you're paid. For simplicity, let's assume interest is not compounded. Okay, so with this, right, we're going to have to build this out a little bit here, and this one's a little bit tricky. So we're going to have quarter 1, quarter 2, quarter 3, quarter 4, then for the year. All right, we'll start here with our beginning cash balance, right? And they're telling us that the beginning cash balance for the upcoming fiscal year is $20,000. Okay, so we get that from here. And for this, right, we're going to run through quarter 1, and that'll help us, show our beginning in quarter 2. So with this, we'll add total receipts, right, our cash inflows of, let's see, $1.80. Right, so if we started with 20, we added $1.80. We're looking at 200 for total cash. Then we're going to back out any cash paid, right? Our disbursements, in this case, it's 260. Right, 200 minus 260 looks like we're in the negative. In this case, right, we have a deficiency in cash. Then we have to kind of consider our financing here. Right, so our borrowing, right, at the beginning of the quarter, looks like over here, let's see how much they're telling us we're borrowing. Okay, so this one we kind of have to back into a little bit. So they're telling us over here, right, that we need a minimum cash balance of $10,000 at the end of the quarter. It's like always the case. We're in the hole negative 60. So to get us there, we got to borrow 70,000. Right, there's other like line items we can do here, repayments, interest. That's going to get us our total financing. Okay, in this case, we're at 70,000. From that, we'll have, let's see, our ending cash of negative 60 plus 70. Right, we're looking at 10,000. Now that guy, right, ending cash from last period will be this period's beginning cash. See how we had to complete that like vertical column first? Now with that, right, we're gonna just move on to the next problem. You could populate these in over here, but I wanted to just kind of give you a glimpse of that for the the cash budget, how that might work. There's calculations here with interest and stuff. Again, I'm more concerned high level that you're just aware of what is a cash budget. We run through like a simple equation with it. This one has a little bit more complexity. And let me put that there on it. All right, so let's go to exercise 8.8 here. It says Gig Harbor Boating is a wholesale distributor of a small recreational sailboat. Management has prepared the following summary data to use in its annual budgeting process. So they're giving us budgeted unit sales, what we plan to sell it per unit, the cost per unit, variable and fixed selling and administrative, one's on a per unit, one's on a per year basis, and then interest expense. They want us to prepare the budgeted income statement. Okay? So first line item on an income statement, right, is going to be our sales. Okay, so you're going to have to look at the formula here, and I'll try to explain it, for this task. So it's going to be 460, right? We plan on selling times 1950. Okay, that's our sales in dollars, 897. After that, we got to back out our cost of goods sold. Right, so again, it's 460 we sold times 1575 cost per unit, right? 724. One minus the other, that'll get us our gross margin, okay, of 172. Then we got to back out our selling, general, and administrative expense. Right, so this one we have to kind of think about for a second here because we have a fixed component, we have a variable component. So we know the fixed is a flat 105. That's great. That's per the year. So what we're going to do here is we'll have the 105 fixed plus we have the variable component that says, hey, it's going to be $75 per unit in this case, and if we sold 460 of them, right, so we'll have our fixed component and our variable component. We're looking at, let's see here. Oh, hold on. This should be in the thousands. That's why it's off. 105,000 plus 75. Okay, yep, there we go. That will get us our net operating income. Take the 172 minus the 139. We're looking at 33. We'll back out interest expense of, let's see here, 14,000. Right, so 33 minus 14. We're looking at 19 of net income. Okay? Nothing, over the top there for it. Just working through a balance or a budgeted income statement. Let's look here at exercise 8.9. Okay? So they're giving us some information. It says the management of a company located in on an avenue has completed the following data to use in preparing its budgeted balance sheet for next year. All right, looks like we're doing a balance sheet here. It says the beginning balance of retained earnings was 28. Net income is budgeted to be 11.5, and dividends are budgeted to be 4,800. They want you to prepare the company's budgeted balance sheet. Okay, so with this, let's start to list this out. Right, so our assets, we're going to have our cash, our accounts receivable, our supplies, our equipment. We got to back out any accumulated depreciation on that. We'll have our PP&E in here, and let's see under that, right? So in the PP&E, I'm sorry, you'll have your equipment, your accumulated depreciation. That will get us your net amount for it, but we'll just keep it there, and that will give us our total assets. Okay, then we got to do our liabilities plus our stockholders' equity. Okay, so our liabilities, we have an account payable, and then under stockholders' equity, we have common stock, retained earnings. That's going to get us total, we can have total liabilities plus stockholders' equity. All right, so some of these we can just plug in from over there. All right, so accounts receivable, it looks like that's $8,100. Just snag it from over there. Supplies, we're looking at $3,200. Equipment, we're looking at $34,000. Accumulated depreciation is 16. And let's see here. If we go down here, our accounts payable, they're telling us $1,800. Common stock, $5,000. Then we got to do our retained earnings and our cash, right? So these are kind of make sense. These are the mystery numbers, our cash and our retained earnings. Okay, so our retained earnings, what we're going to have to do here is a retained earnings roll forward. Right, so you have your beginning plus your net income minus your dividends equals your ending. Right, so they're telling us that the beginning balance was $28,000. Our net income, we're expecting it to be $11,500. Dividends, $4,800. Right, so we'll do beginning plus net income minus our dividends. That's going to get us ending retained earnings of, let's see here, $34,700. So our total liabilities and stockholders' equity is going to have to equal those three guys of $41,500. Right, over here it looks like from what we have, right, we're at $29,300. This has to equal $41,500, right? So our total assets equal our total liabilities and stockholders' equity. So here's the deal, right? If it has to equal $41,500, but we're at $29,300, right? All of these guys. That means the cash balance has to be $12,200. Okay, so that was like a little bit of a throwback there to your financial accounting days if you forgot that retained earnings formula. Right, it's your beginning plus your net income minus any dividends, gets you your ending. So that was the idea, right? We were trying to run through in these problems a little bit of a snippet of each budget, right? Work our way through, check it out. So with that, I'm going to end the lecture here, and we will see you in the next chapter. So, all right, thanks everyone.